This is the fourplex I've been working on. Had it for a little while, and I legalized the basement suites. There's one side that has less, doesn't have the pretty stuff done to it yet. There's still some lift left in it, is the point I'm trying to make.
Okay.
It's legal, it's got a new floor, new drywall, all that kind of stuff, but the kitchen needs to be pretty and the bathroom needs to be pretty. And so I was thinking of JVing one side just to free up some of that capital. And I chose this side because I thought if I could offer it at a discounted price and build in that renovations so that there'd be enough room there to add quite the lift, because the cash flow, rents in Calgary are going up, but they haven't quite gone up a bit more. So the cash flow is a little on the lower side, but there'll be a lot on if I left room for appreciation. I was hoping that it'd make it a better deal. And that's kind of what I wanted to run past you, if this makes sense. So
Okay, I have a question.
Yeah.
So this is a duplex. So both sides together, are they 860,000? And so one side is 430?
Yeah.
Okay, and are they separate titles?
I'm in the process of doing that. It's got separate meters, separate addresses. It just has to have the title split. So that's a surveyor thing. And that's the whole debate, is should I do this JV? And if the JV doesn't make sense, then what's the point in splitting the title? Because
Right.
that's going to cost some money. But if we think the JV makes sense, then I would go ahead and split the title and JV it. If it were split and I were to list it, I think looking just at the tax assessment of all the houses on the street, because they're all exactly like this, but this is the only one left that's not split. And they're between 530 and 560 a side. So the 430 is the original price, which leaves a lot of, it means I get my money back and then we do the renovations, but that leaves some upside for the investor.
Yeah.
So if 430 was the purchase price, then we do 30,000 in renovations, the ARV would end up actually being the 520.
Okay.
But I would discourage the new person at taking it all out and refinancing, because then it doesn't cash flow.
Right.
So it's that case of finding that balanced spot. But then, not everybody wants cash flow. Some people are happy with the equity growth and it pays for itself. Maybe you don't want cash flow.
Yeah.
So that's what we're looking at. So the rent is going to be about $2,500 a month, mortgage payment, taxes.
That rent is for the upstairs and the downstairs of half the duplex.
Yeah.
Okay.
And I know that because that's what I'm getting on the other side.
And once it's renovated, do you think you could get more, or do you think that that's what it
Not
would
yet.
be? Okay.
Not yet. Maybe next year.
Okay.
If Calgary keeps booming, but no.
Yeah.
But they pay their own utilities, which is nice. I put property management in because you tell us we should, but I'm willing to take less on the cash flow. Like, I just don't know if this is a good deal for a JV partner, if they were to get that cash flow.
So here's the deal.
Yeah.
So is that your main question? Is this a good deal for a JV partner?
Pretty much.
Okay. So when we look at potential deals all across the country that people are investing in, there's so many different aspects that we can look at. Some look at cash flow, some look at equity appreciation, some look at everything combined. And so every investor is going to have different criteria. So my answer to you on this would be Calgary is absolutely a great market to be buying in right now. It has a lot of potential for the future. It has a lot of potential for going up in value, but probably one of the highest potential out of all the major cities in the country, because it's still such low property values there compared to other major cities in the country. This is an investment that, including renovations, is around $120,000. It cash flows, and there's a huge upside once you do the renovation as far as equity appreciation. So all of that included, I would say absolutely this is a good opportunity for an investor, for a potential JV partner. They may or may not want to refinance in the future and get some of their down. The thing is cash flow might be less, but they'll get some of their down payment back.
Yeah.
Each potential JV partner can weigh which they would prefer, but is it a good deal to offer as a JV? Absolutely. Especially because you already know the rents. This isn't a question. You already know the values on that street because of everything else that's there. You have the potential to split the titles, which always is a good thing to appreciate value. So there's a lot of pluses in something like this. So I would say, yes, it's a great JV opportunity.
Okay. And I did the numbers so that when they refinanced, that they did get some of their money back, but I tried to refinance at a level where it still cash flowed a little bit, but we can obviously play with whatever point they refinance and how much they take back out.
Yeah. So
Like
let
if
me
we
ask
did
you
this
a
as a
question.
burr.
If you did get a JV partner on this, who would
Mhm.
be managing the property, like property
Me.
management wise? You would
Me.
manage it. Are
Yeah.
you going to charge that 4%?
Well, this is, okay, options. Should I charge the 4% and then take a smaller amount? Like I don't need to do 50-50 on the cash flow. Would it be better to put that at 0 and, split that? But then if we do a 50-50 split on the cash flow, then the partner gets less cash flow.
Right. So let's just assume that, okay, so repairs and maintenance, you have a fairly low percentage. You do as vacancy as well. So that's another $100 a month. So this, when we look at the hard costs on this property, you're cash flowing roughly about $500 a month. Tenants pay the utilities. So, you'd end up splitting that 250 between you and a partner. You could increase that property management. If I was to look at this and say, put that up to 10%, can you just show me what it looks like at 10%? Okay. So the way that I would speak to a joint venture partner is this, that you are taking a 10% property management fee to manage it. You'll take care of everything. You get your $250 a month, Liz. But I would tell a potential partner that they will get 100% of the cash flow. And so, when a partner looks at that and they say, well, I get 100% of the cash flow, that really in this scenario, assuming there's no repairs and maintenance or vacancy, is $268 a month. So the partner gets $268, you get $250. But to me, it sounds way nicer to a potential partner if they get 100% of the cash flow.
Okay.
So it depends on how you want to word it. And this is the whole thing, guys, is when it comes to talking to a potential partner, you could then make that property management 0 and split the cash flow 50-50, and you do the management for free. But what happens if something happens to Liz and you have to now have a property manager take care of it? I would prefer to kind of have that cost taken care of. So whether you take care of it, Liz, and pocket that 250, or whether a property management company takes care of it and pockets that 250, I know that I have whatever's on top of that as far as cash flow. So as a potential investor, I would appreciate that better than making you 0 and us splitting it.
Okay, sure, that makes sense. All right.
But it's all about how we communicate it, and it's all about what your potential partner prefers. And so I would leave that up for negotiation and start conversations and see where it goes.
Okay, excellent. Thanks very much.
You're welcome.